Official reports say the luxury market is wobbling, but here is the shock. In just 2 years, 50 million buyers have disappeared, and the shoppers who remain are about half as active, even as global sales for top brands like LVMH drift down by billions. If the so-called collapse of the luxury economy does not look obvious, it is because a new divide is hiding the pain, disguised by record hotel bills and shrinking crowds at flagship stores. Behind the scenes, brands are fighting to survive as their customer base melts away. Here is what most headlines are missing, and why the real story starts with how we define luxury itself. Luxury means different things depending on where you look. On one side are personal luxury goods, designer handbags, leather shoes, watches, fine jewelry, beauty products, and high-end eyewear. These are the items that fill the windows on Bond Street or the Rue du Faubourg Saint-Honoré, and together, they reached an estimated 364 billion euros in sales in 2024. On the other side is the world of experiences, hotels, exclusive travel, and immersive events. Here, the numbers tell a different story. Ultra-luxury hotels now command average daily rates above $1,245, with revenue per available room up more than 10% in 2025, according to the Financial Times. So while some luxury goods are facing a mild 2% dip, forecast at around 358 billion euros in 2025, top-end experiences are still seeing growth, fueled by the wealthiest clients. The key distinction is this: a drop from the highest peak is not the same as a collapse. The luxury economy is vast, but it is not moving in one direction. The luxury boom that followed the end of pandemic restrictions did not last. As inflation took hold and interest rates climbed, the mood shifted. The world's largest luxury group, LVMH, serves as a kind of thermometer for the sector. In 2024, LVMH reported revenue of about 84.7 billion euros, still a giant, but down to around 80.8 billion euros in 2025. That is a drop of nearly 4 billion euros in a single year, a clear sign that the easy growth of the post-COVID surge had cooled. The slowdown was not just about currency swings or one-off factors. Luxury companies across Europe pointed to squeezed household budgets and more cautious spending, especially among upper-middle-class buyers who once drove the sector's expansion. While the market remains vast, the pace has changed. Companies that once counted on steady gains now face a tougher environment where every percentage point of growth is harder to win. The days of effortless sales are over, and the numbers bear it out. Luxury brands are now facing a problem that doesn't show up in headline sales numbers. The pool of people actually buying luxury goods is shrinking. Bain & Company estimates that the global customer base for personal luxury goods dropped from about 400 million people in 2022 to 350 million by the end of 2024, and is expected to fall further to around 340 million in 2025. Within this shrinking group, the share of truly active shoppers, people who make regular purchases, has dropped even faster, from roughly 60% in 2022 to somewhere between 40 and 45% by 2025. That means fewer buyers are driving the entire market, and brands are competing harder for the attention of a smaller, more selective audience. Bain's research, built on global purchase panels and consumer surveys, points to inflation and price fatigue as key reasons for this drop-off. Many former buyers now say luxury feels out of reach, and some have simply walked away. The risk is clear. When participation thins, the foundation of future growth starts to look less stable. Luxury brands have relied on a playbook known as the elevation strategy. This approach means raising sticker prices, cutting back on entry-level products, and nudging shoppers toward more expensive items. According to KPMG and HSBC, the prices of leading luxury brands have jumped about 54% since 2019. But this is not just about inflation. Roughly 80% of all luxury market growth between 2019 and 2023 came from higher prices, not from selling more handbags, watches, or shoes. On paper, that looks like progress, but it masks a shrinking pool of buyers. As brands pushed prices up, fewer people could justify the spend. Houlihan Lokey's research shows that by 2024, average selling price accounted for about 60% of growth, but that trend hit a ceiling. When prices went up by 8%, unit volumes dropped by 10%. The effect rippled through the sector. Bain and Altagamma estimate that 35 to 40% of luxury goods in 2025 were sold at a discount, the highest share in over a decade. Elevation can boost margins for a while, but it also risks turning luxury into something fewer people want or can afford. At the very top of the luxury world, some brands have managed not only to hold their ground, but to thrive, even as the broader sector cools. Hermes stands out as the clearest example. In 2024, Hermes reported revenue of nearly 15.2 billion euros, up 15% at constant exchange rates. Its operating income reached about 6.2 billion euros, translating to a remarkable margin of 40.5%. This kind of performance is rare in any industry, but especially striking when so many others are feeling pressure. The secret lies in scarcity and discipline. Hermes tightly controls its supply, limits production, and maintains long waiting lists for its most coveted items. Products like the Birkin bag remain status symbols not just for their design, but for their rarity and ability to hold value over time. Meanwhile, LVMH, the world's largest luxury group, reported profit from recurring operations of about 19.6 billion euros in 2024, easing to around 17.8 billion euros in 2025. Even with this decline, LVMH's fashion and leather goods division held onto a margin near 35%, showing that scale and brand strength can still deliver strong results. These numbers highlight a growing divide. While some houses face headwinds, others continue to set the standard for profitability and resilience. Pressure is mounting on brands that once seemed untouchable. Gucci, the crown jewel of Kering, reported revenue of about 7.7 billion euros in 2024, a drop of 23% compared to the previous year. Retail sales slid by 21% on a comparable basis, and wholesale revenue fell 28%. For a company with high fixed costs, from flagship stores to global marketing campaigns, that kind of decline cuts deep. When demand cools, profits can unravel quickly, and Kering has had to pour resources into new designs and fresh marketing just to steady the ship. Chanel, another icon, offers a different warning. Its operating profit is reported to have dropped by about 30% to around 4.3 billion euros in 2024, with margins slipping to 24%. Over the past 5 years, the price of a classic quilted Chanel bag has more than doubled, reaching roughly 10,300 euros. For many shoppers, price hikes outpaced their paychecks, and the result wasn't just fewer bags sold, it was a growing sense of doubt about what luxury really means when the value story starts to crack. Europe's luxury boutiques and flagship streets remain crowded, but the real driver isn't always local shoppers. Bain estimates that the European personal luxury goods market grew by 3 to 4% in 2024, reaching around 110 billion euros. Much of that momentum came from international visitors. Tax-free sales surged by 10 to 15% compared to the previous year, while the average purchase per tourist stayed steady. This means the apparent bustle on avenues like the Champs-Élysées often reflects a wave of travelers making up for hesitant local demand. Tourism can keep storefronts busy even as regular European buyers pull back. China's role in the luxury economy has grown more unpredictable. In 2025, mainland China's personal luxury market contracted by 3 to 5% according to Bain, even as signs of recovery appeared late in the year. 65% of Chinese luxury spending now happens at home, reflecting a shift away from overseas shopping as price differences narrow and local promotions multiply. This domestic focus has changed which brands and categories win. Beauty and eyewear posted growth between 3 and 5%, driven by shoppers looking for affordable treats. Apparel and leather goods lagged, with some segments slipping as much as 2%. These shifts ripple far beyond China, reshaping demand patterns for global luxury brands. In January 2026, Saks Global scrambled to secure $1.75 billion in emergency financing, including a $1 billion debtor-in-possession loan to keep stores open and pay suppliers as it prepared for a Chapter 11 filing. Today, luxury is no longer about more buyers, it is about fewer, wealthier ones, and the gap keeps widening. As brands fight to stay exclusive, the middle is squeezed out. The next chapter will not be about status symbols, but about who is still invited inside. Share your perspective below.